Welcome to the Understanding the Employee Retention Credit webinar, the latest in our Navigating Your Business Through COVID-19 webinar series. These webinars are being recorded and will be available for review on our website in approximately 24 hours after the session. Today's webinar is an overview of the latest guidance on eligibility, maximizing the ERC credit with PPP loans, and best practices for claiming the ERC credit. I'm Bob Weston, Director of the SBTDC's statewide COVID-19 Business Recovery and Resiliency Program, a CARES Act funded initiative expanding Small Business and Technology Development Center capacity to assist businesses in successfully navigating the COVID-19 crisis. The SBTDC is the business and technology extension of the University of North Carolina system. For over 36 years, the SBTDC has been a resource for business owners, providing confidential counseling, educational programs, and a connection to university resources that helps them make their businesses better. The SBTDC operates 11 regional centers across the state that are hosted by our UNC system campuses, with 16 offices serving all 100 counties in North Carolina. Business resiliency counselors are now embedded with each of our regional centers to assist you. To request a virtual appointment with a business resiliency counselor, go to www.sbtdc.org/ERFC. I'd like to welcome you on behalf of Byron Hicks, Executive State Director of the SBTDC. Byron was named the State Director of the Small Business and Technology Development Center in January 2021. He also serves as the Assistant Vice Chancellor of Business and Technology Extension Programs in the Office of External Affairs Partnerships and Economic Development at NC State University. I'd like to introduce you to our speaker today, John Howard. John is a Senior Tax Manager with Williams, Overman & Pierce. He primarily works in tax compliance consulting and advisory services for closely held businesses and owners. John has experience with businesses across many industries, and his specializations include real estate, construction, and professional service providers. John, welcome to the program.
Thank you, Bob. Get my screen share going. I appreciate that introduction. You able to see the PowerPoint?
You're up.
Good deal. Well, as Bob mentioned, my name is John Howard. I'm a Senior Tax Manager with Williams, Overman & Pierce, based out of the Raleigh office. And I appreciate the opportunity to be here today and present on the Employee Retention Credit. So over the last, say, 12 to 18 months, we've been working with a lot of businesses on the Employee Retention Credit. Ranging anywhere from the neighborhood landscaper with just 2 employees that would get back $14,000 per quarter, up to the commercial contractor with 300 employees getting back over $2 million per quarter. The common theme among all businesses that we work with is a lack of awareness on the credit. Either they haven't heard about it, or they have heard about it but automatically think that they don't qualify. So the purpose of this presentation is really to provide a high-level overview of the Employee Retention Credit and give you a sufficient understanding to be able to talk about it with your CPA or other advisor. So the few of the things we'll be going over today, the background and legislative acts that created the credit and changed the rules on the credit, some of the methods of eligibility, including some common issues and the nuances of each. We'll also be discussing how the credit amount is calculated, claimed, and how it's taxed, as well as the interaction with the Paycheck Protection Program, also known as PPP loans, and how to maximize the credit when you receive the PPP loan. We'll also be discussing some of the best practices we've seen in working with clients on this, and then wrapping up with the Q&A session at the end of the presentation. And also for my legal disclaimer plug, this is for informational purposes only, not intended to be tax advice, so please consult your advisor. Also, another disclaimer, due to the constantly evolving laws surrounding this credit, there's a likely chance that this presentation will no longer be accurate in 6 months or a year, or even 2 weeks from now. So it's always best to consult your advisor on the latest guidance. All right, jumping right in. So as mentioned earlier, the biggest issue we've seen is a lack of awareness. This applies to business owners, advisors, and other tax professionals. For many tax professionals, myself included, it's been a challenge to keep up with the existing compliance work that we have, just due to the massive amount of tax reform over the last few years, starting with the Tax Cuts and Jobs Act in late 2017. Then came along COVID and the related staffing shortages there, and like many other businesses, accounting professionals are spread pretty thin. So definitely don't be too critical of your CPA or advisor if they hadn't gotten into the weeds on this yet. To kind of contribute further, the laws regarding the employee retention credit have changed dramatically since first introduced with the CARES Act back in March of 2020. As I'm sure you know, the CARES Act was the $2.2 trillion bill in response to COVID. The bill included stimulus payments, unemployment benefits, the Paycheck Protection Program, and the employee retention credit. The big caveat in the CARES Act was that eligibility for the employee retention credit was limited to those not receiving a PPP loan. This took it off the table for a lot of businesses and is the source of a lot of confusion today regarding eligibility. There's still a lot of outdated guidance available online based on this original CARES Act, and that would be pretty misleading if you're looking at that information and credit eligibility today. So fast forward 9 months later to December of 2020, and the Consolidated Appropriations Act revised the law, and it revised it to allow businesses who receive PPP loans to also claim the employee retention credit. This was obviously a huge deal to many businesses. Additionally, this is the act that extended the employee retention credit into the first 2 quarters of 2021. It also significantly increased the credit amount from $5,000 per employee per year to $7,000 per employee per quarter. To make it even more accessible, it lowered the threshold for eligibility from a 50% decline to a 20% decline. We then had the American Rescue Plan Act signed this past March. This extended the employee retention credit through the end of 2021. It also added additional ways to qualify for the credit, which was very favorable to taxpayers. Then just 4 weeks ago, on November 15th of 2021, the Infrastructure Investment and Jobs Act was signed. And this ended the employee retention credit at the end of the 3rd quarter in 2021 by taking Q4 back off the table for most businesses. And while this is disappointing not being able to claim the credit for Q4 of 2021, there's still a lot of unutilized opportunity to go back and claim the credit for the existing available quarters in 2020 and 2021. So as you can kind of see here, the back and forth changes in the laws regarding this credit have really led to a lot of confusion and misinformation out there. So jumping right in, the big question, how do you qualify? So there are 3 main ways at this point to qualify for the employee retention credit. The first way to qualify is to have a significant decline in gross receipts. For 2021, this means a 20% reduction in gross receipts. For 2020, this means a 50% reduction in gross receipts. And gross receipts here are measured on a tax basis, but we'll go into more details on this in a minute. The second way to qualify is if the business experienced a full or partial shutdown due to government mandate. And we're going to dig deeper into this one as well. The third way to qualify is to be what's called a recovery startup business. And this is a business that began operations after February 15th, 2021, with under $1 million in gross receipts. And this third method is only available for Q3 and Q4 of 2021 and limited to a maximum credit amount of $50,000 per quarter. So this is the one area where the credit is still on the table for the 4th quarter of 2021. We haven't seen too many startups happening in the past year, but this is certainly something to still keep in mind. So going back to that first way to qualify, the significant decline in gross receipts. So for 2021, again, this means a 20% decline in quarterly revenue compared to the same quarter in 2019. For 2020, the bar is a little lower, or excuse me, a little higher, where you needed a 50% decline in quarterly revenue compared to the same quarter in 2019. The key part to note here is that, generally speaking, the comparison year is 2019 for both the 2020 credit and the 2021 credit. There are some exceptions there for new businesses, or if you acquired a business that are pretty taxpayer friendly, which would include the ability to use 2019 gross receipts for an acquired business, even if you didn't own that business in 19. So definitely worth digging into deeper if you're in that situation. We're going to look at a quick example for 2021. So we have ABC Corporation here. In 2019 first quarter, they had $100,000 in gross receipts. For that same quarter in 2021, they had $78,000 in gross receipts. This represents a 22% decline, thus making them eligible for the first quarter of 2021. Similarly, they had another $100,000 in Q2 of 2019 compared to $70,000 in Q2 of 2021. This would represent a 30% decline, and the ABC Corporation would be eligible for the second quarter as well. So at this point, ABC Corp is eligible for both the first and second quarter of 2021, but there's still more. So unique for 2021 only, there is an election available to use the prior quarter's gross receipts decline to determine eligibility. So in this case, in doing so, ABC Corp would be eligible for Q3 2021 based on that decline in Q2, regardless of what the actual gross receipts are in Q3. So essentially, you're getting an extra quarter on top of any qualifying quarter in 2021. For 2020, there's a similar rule, but applied in a little bit different way. For 2020, once you hit that 50% decline in a quarter, that starts the period of your significant decline, and you're considered to still be eligible and in a period of significant decline until the end of the quarter in which gross receipts recover to 80% of the prior year. So here again, this is essentially giving you at least one additional quarter in 2020 in addition to the quarter with the 50% decline. So there are a few additional considerations and some nuances for the decline in gross receipts method. First, and probably most important, is the requirement to compare gross receipts based on your method of accounting used for income tax purposes. This is probably the biggest thing we see missed in working with clients and other people on this. So if your tax return is on a cash basis, then the comparison of gross receipts should be done on a cash basis as well. Likewise, if you use the accrual method of accounting on your tax returns, the accrual method should be done or used rather for determining gross receipts. If you're in construction and you're a contractor with long-term contracts, you would use whatever method is used on the tax return to account for those contracts, whether it be completed contract or percentage of completion or any combination of those. Secondly, the gross receipts does not include PPP loan forgiveness, shuttered venue grants, or other grants as part of the CARES Act. So if you think about the PPP loan forgiveness, the accounting required to remove the PPP loan liability from the books typically results in loan forgiveness income being recognized on your profit and loss statement. Then on the tax return, it's typically moved to tax exempt income with a book to tax adjustment. So if you have that amount included in your top line, you would want to make sure to take that out. Lastly, in addition to gross sales, gross receipts also includes any income from investments. This would be your interest income or your dividend income. Also, gross rents and net capital gain. And there is a distinction here between gross rents and the net capital gain. A lot of people report net rental income on their tax return, but for this purpose, you have to compare gross rents. So the second way to qualify for the credit is for operations to be fully or partially suspended, and then you would be subject to a government mandated shutdown. So if you have the operations that are fully or partially suspended during the quarter due to due to orders from a governmental authority, you could be eligible under this method. If you're eligible under this method, you do not need to meet the gross receipts decline test. And these orders can be federal, state, local, or other orders there. A lot of counties were doing their own thing, but still issuing government orders. So it's really imperative to look at it on a case-by-case basis. Some of the examples of this would include the closure of non-essential businesses, reductions in occupant capacity, reductions of hours of operation, or supply chain issues if vendors or suppliers are themselves shut down due to a government mandate. So even if your business was not shut down with any mandates, but you had a supplier or vendor for a critical material in your business that was shut down due to the mandate, this could allow you to qualify. Now for some additional considerations with the government shutdown. There can be some clear situations for qualifying, especially for full shutdowns. Eligibility for partial shutdowns is very much based on the facts and circumstances regarding that shutdown. With partial shutdowns, you need what's called a more than nominal portion of your business operations to be suspended in order to qualify. For this purpose, the IRS has provided a safe harbor that says a more than nominal portion of your business means at least 10% of gross receipts or at least 10% of total hours of service, both based on information from 2019. So example of this would be if you had a restaurant with no on-site dining, but they were still providing curbside service. Or if you had a retailer that was having to close its storefront locations, but were still able to operate online. Also, it's worth pointing out that a reduction on hours of operations is considered as a partial suspension of operations, and you don't have to apply those safe harbor tests there. If a business lost customers due to a stay-at-home order, this would not be qualified. That would be an order or a mandate affecting customers, but you really need an order affecting the business itself. Additionally, if the employer was allowed or required to close, but still able to continue comparable operations by requiring its employees to telework, this would not be a qualifying shutdown either. So as you could probably imagine, determining eligibility under the government shutdown is not always very clear cut. So now we're going to touch on how the credit is calculated, claimed, and taxed. So for 2021, the credit is based on 70% of wages paid up to $10,000 per quarter for each employee. If you had an employee making an annual salary of $40,000 earned evenly throughout the year, their credit would be $7,000 per quarter. If you had 10 employees making $40,000 annually, you will be looking at $70,000 per quarter. For 2020, the credit is based on 50% of wages paid up to $10,000 per year for each employee. So 2021, $10,000 per quarter for each employee. 2020, $10,000 per year for each employee. So if you had one employee making $40,000 annually or $10,000 per quarter in 2020, you would have a maximum credit amount of $5,000 per that employee. So to claim the credit is taken on the quarterly payroll tax returns on Form 941. At this point, all of the available quarters have likely been filed, as these forms are due the end of the month following the end of the quarter. So an amended 941 now must be filed to claim the credit. Good news here is that the IRS does allow these returns to be amended until the later of 3 years from the date filed or 2 years from the date the tax is paid. Unfortunately, we aren't able to electronically file those, and they have to be paper filed, and there's quite a long processing time at this point, but still able to go back and file it. Bad news, the credit is taxable in the year the qualifying wages were incurred. This credit reduces the salary expense for that year. the IRS is requiring that amended returns be filed. That means that if you calculate a $50,000 credit for 2020 Q4, after you've already filed the 2020 tax returns, you're required to go back and amend that 2020 return to reduce your salary expense by the $50,000 credit. From the IRS perspective, the timing of when you actually receive the credit isn't relevant, nor is your method of accounting with regard to when to adjust salary expenses. A lot of people think that just because they're on cash basis, they don't have to recognize it until that cash is actually received, and that's not the case here. So now we're going to talk about the interaction with PPP and some other considerations. So as mentioned earlier, the Consolidated Appropriations Act did revise the law to allow businesses to receive both the Employee Retention Credit and PPP loans, with the caveat that you could not take the credit on the same wages that were used to receive loan forgiveness. In other words, no double dipping were allowed on the wages. With this change came some opportunity to utilize some strategy to maximize the Employee Retention Credit while still receiving full forgiveness. This is especially important for any PPP Round 2 loans for which forgiveness has not been submitted. So when applying for forgiveness, assuming you have no reductions in employees, it may be beneficial to use the longest covered period that you can, which is generally 24 weeks. In doing so, you are widening the window from which wages can be pulled from in order to get full forgiveness. So for example, if you were to receive a Round 2 loan on April 1st of 2021 and use an 8-week covered period, all of those wages to get forgiveness must come from April and May of 2021. If you later determine that you are eligible for the Employee Retention Credit for the second quarter of 2021, you could be very limited on those wages available to be used for the credit. Alternatively, if you used a 24-week covered period on that same loan that you received on April 1st, you would have through September to pull wages for forgiveness. So this would allow you to use the Q3 wages to potentially receive full forgiveness while still having all of the second quarter wages available for the Employee Retention Credit. It's worth keeping in mind there's several factors here to consider when you're determining what cover period to use in addition to the credit, such as changes in headcount, the amount of wages that were paid, and what other non-payroll costs you have. And speaking of non-payroll costs, on Round 1 forgiveness, when we thought the Employee Retention Credit was off the table, we typically used only payroll costs when applying for forgiveness. The reason for this was that it was easy to document and support. We simply provide the payroll reports in the 941s. Now that the law has changed, then we look to maximize the non-payroll costs, such as utilities, rent, covered operations, and covered supplier costs. In doing so, this does free up more payroll for the credit. But also keep in mind here, there is a requirement to use 60% of the loan proceeds on payroll costs. So there are limits in play here. So obviously there's quite a few variables coming into play when talking about loan forgiveness and maximizing the credit, and what is beneficial for one business could not be feasible for another. A few other considerations to keep in mind with regard to the credit, and please note this isn't an all-inclusive list, but more so just the items that affect a lot of businesses that we run into a lot. The first one is with regard to the aggregation rules for related entities. These aggregation rules, similar to those applied to retirement plans, are also applicable to the Employee Retention Credit. If you have 2 or more businesses that are considered related entities under these rules, then all of those entities are treated as one employer for purposes of the Employee Retention Credit. So this means you must include gross receipts from all entities when comparing quarters to determine eligibility, as well as the dollar amounts for all those entities. For example, if you have one employee working in 2 related entities in 2021, the total credit allowed for that employee is $7,000 between both entities. The other thing with the aggregation rules is this could be beneficial. It could hurt you. It really just depends on the situation and what's going on with the gross receipts. The second big consideration is for wages paid to owners and related parties. There have been some interesting developments on this since the credit was first introduced. And this is really the only part of the credit that is not favorable at all to businesses. specifically those businesses employing family members. So in short, if you're considered a majority owner and have any living siblings or lineal relatives, meaning parents, grandparents, children, or grandchildren, then neither you nor your spouse's wages are considered qualified. To take it a step even further, if you're considered a majority owner, you cannot include wages paid to children, grandchildren, siblings, including step siblings, parents or step parents, nieces or nephews, aunts or uncles, or in-laws. This is a very restrictive clause here, and many people think the IRS missed the boat big time with this interpretation. But as the law currently stands, we're stuck with this. So to kind of wrap things up, I'd like to touch base on some of the best practices that we've seen in working with businesses to claim the credit. So if you only take away one thing from this presentation, it should be to use an appropriate advisor. We've seen many payroll providers offering to calculate the credit, as well as consultants who are charging fees based on a percentage of the credit, sometimes up to 25% of the credit. But just keep in mind, you need an advisor that is keeping your best interest in mind. Some of these consulting firms have recently popped up and may not be around in 3 to 5 years when the IRS comes looking for additional information or support. And then given the extended statute of limitations here, it is pretty likely that the IRS would be examining some of these credits, especially the larger ones. Also, because of this, you should be making sure to document your eligibility and credit calculation thoroughly. So for government shutdowns, this would mean saving copies of the specific orders or decrees which mandate the shutdown. Currently, nc.gov has copies of the executive orders put out by the governor, so you'd want to save copies of those just in case they're not readily accessible later, specifically 5 years from now. For the gross receipts decline, you'd want to document the quarter profit and loss statements supporting that decline. For a cash basis taxpayer, you could use bank statements to do this. If you're on one accrual method or a contractor using percentage of completion, you'll likely need some financial statements to support this or job schedules. As mentioned a minute ago, the IRS did extend the statute of limitations, which is the amount of time that they're allowed to come back and examine these. It's increased to 5 years. Additionally, listed here on this slide are some resources from the IRS. They've now issued 4 notices on the employee retention credit. So this is really the best place to start for guidance. Again, when you're doing Google searches or looking online otherwise, there's a lot of outdated information out there. So really be prudent when you're doing this and go straight to the source. Even the irs.gov website, on the face of the website, has some outdated information. So that's why it's really necessary to dig in deep on these notices. In closing, I hope this has been informative and provides some insight on the credit to allow your business to take advantage of it. And I think we're going to open it up now for any questions. Bob, I'm going to give it back to you.
Yeah, I just want everybody to know you should see at the bottom of your screen a Q&A button that you can click on, and you can submit questions through that. Unfortunately, we can't take live questions over voice in this format, but we have a couple of questions coming in, and I'm just going to tee them up for John. John, great presentation. We appreciate it. I especially appreciate the information. Being an advisor, that there are, when you go and search on the IRS site about this credit, a lot of the pages come up and say this isn't current information and you have to go somewhere else. So those notices were very helpful to find. We have a question from Jesse. It says, I may have missed the portion regarding the recovery startup businesses. I opened up a startup fitness studio in September. I'm the sole owner and only employee. Could I possibly qualify for any credit?
That's a good question. Assuming that you're talking about September of 2021, there is a potential ability to qualify for the credit there. You would have to look at, for one, how you're structured for tax purposes. For example, if you're an S Corp and you're paying yourself a salary and you're a 100% owner and you have no living relatives, meaning no lineal, your parents, no children, no siblings, then your wages would be qualified. Otherwise, if you have any living parents, children, or siblings, unfortunately, your wages would be disqualified. That's going back to kind of those restrictive rules that we think the IRS missed the boat on. So really, it would just depend on your specific situation there.
Okay, now is that they have to be working in the business or just if you have them?
Just if you have them, they do not have to be working in the business at all. So if you have a brother that is living in Europe and never even heard of your business, that still disqualifies your wages.
Wow. Okay. We have another question here about the recording. Is it going to be sent out? The recording will not be sent out, but it will be available on our website. They're going to put the website in and answer it online on the question, so you'll have it. The next question is the revenue reduction calculation based on cash if our tax returns are based on cash, a cash basis, even though accounting is based on accrual?
Yes, the method that you use to do the comparison gross receipts is whatever method you're using on your tax return, regardless of what you're doing internally.
Okay. And y'all feel free, if you have additional questions or anything you want clarified, you can type them in using the Q&A button at the bottom of your screen. John, we have a lot of people that still are a little bit confused about the changes of PPP eligible, being eligible for PPP and being eligible for the tax credit. And can you clarify that again? They are eligible?
Yeah, sure. So originally when the CARES Act first came out, the CARES Act stated that if you were receiving PPP funds, you were not eligible for the employee retention credit, period. It was later revised to say that you are eligible for the employee retention credit if you receive PPP funds. You just can't double dip on the wages. So what this means is if you're looking at your a period for which you're eligible, say a second quarter of 2021, and you had PPP round 2, the wages that you're using to get forgiveness of round 2, so what's in your covered period, those specific wages can't be used also to claim the employee retention credit. So if you're paying your employees an amount where you are getting full forgiveness and there's still additional wages left that you don't need to get forgiveness, you can use those wages in order to qualify for the employee retention credit. Alternatively, if you max out on the employee retention credit based on the wages paid, then there may be some excess wages there that you use for forgiveness. You can then factor in your non-payroll costs that you want to maximize up to the limitations in order to get that full forgiveness. And that's what the benefit is of spreading out that covered period, is that you're able to pull from a bigger window for these wages to get forgiveness from.
Okay, so we have a question from Mario. So they're in their industry, which is in commercial cleaning. They did not close their doors, but they lost a lot of clients due to the government shutdown. In other words, their clients were closed, so they lost business. Would they qualify based on that? They don't qualify based on the amount of revenue lost.
That's a good question. So that's really getting into the subjective area of the government shutdown. There are some references in the IRS FAQs about this specific situation. If you have, if your customers were shut down or there were requirements there for them to comply with government mandates that didn't allow you to operate your business there, where that would be considered a, potentially a partial shutdown. It would really be based on the number of businesses that this applied to. For example, if your business was solely cleaning retail shops and all the retail shops were closed, this would be a strong likelihood that you would qualify for a shutdown. Alternatively, if your business was cleaning accounting firm offices that were deemed essential and they were operating throughout the whole period, that would be a little bit more questionable. So it really is based on your client base, what those government orders were affecting them, and what the reason is behind their no longer using your services.
Great. Okay. Can you clarify for me a little bit? You mentioned that if an employer had not claimed the employee retention credit, that they could go back and revise their returns to claim it. But if they filed for PPP forgiveness and they used a period that didn't maximize their eligibility, is there any way they can go back and revise that?
That's another good question. So with talking about the PPP loan forgiveness that has been submitted already, depending on what forgiveness application you used, which was based on what your dollar amount was, as well as the changes in your full-time equivalent to your head count, that dictated what form you used. If you used a form that required you to specify a covered period, you are bound to that covered period for the PPP loan forgiveness. There is no getting around that. So for those, for example, the second and third quarter of 2020, at that time, we didn't even think that the employer retention credit was on the table. It's not really fair, but you are still bound by however you submitted that round one application. There is some leeway on some of the applications where you didn't have to specify the covered period or specify which cost you're using in order to get full forgiveness. I believe this was for loans under 150,000 that when there was no decrease in headcount. That was a pretty simplified application filed there, and no covered period had to be specified. In that case, you're free to use anywhere from the 8 to the 24-week period. But unfortunately, if you did file an application and already list a covered period there, you are stuck with that for forgiveness. That's why it's important for, if you're looking at the PPP round 2 right now and haven't already submitted that application, it's really worth examining the employee retention credit first, just to make sure that there's no considerations there that you might want to open up that window even further. Now, obviously, if you had a decline in employees or headcount, and you're looking to not have a reduction in your payroll costs, you might not be able to extend that covered period to the full 24 weeks. But that's really just based on the specific situation of that business.
Mm-hmm. Okay, going back to our previous question from Mario, he does say, added a comment, he said that 25% of their business was servicing restaurants. Again, that was a commercial cleaning business. So restaurants were hit really hard and a lot of them were closed. So would that possibly qualify as?
Yeah, I would say that would be a more than nominal impact, and that would have a strong likelihood of qualifying.
Okay. Here's a question. Don't think I can pronounce the name. Okay, I'm not sure how to pronounce it, but anyway, it says, if the PPP forgiveness was based on covered period wages that ended in Q2 2020, if they had a gross receipt reduction of 50% in 2020 Q3 and Q4, can they claim those wages for the ERC? And there's a follow-up.
So if I'm understanding correctly, you're saying the covered period ended at the end of Q2 in 2020, so by June 30th or before. And then they also qualified for the employer retention credit for Q3 or Q4. Yes, so all of those wages for Q3 or 4 would be eligible for the employer retention credit, being that your covered period ended prior to the start of Q3.
Okay, and they had they had a 50% reduction in Q3 and Q4. So would that make them eligible for Q1 of 2021 because the following quarter is eligible?
Yes, that they would be eligible for Q1 of 2021, but not because of the following quarter. It would more so be because of the 2021 available election to use the prior quarter gross receipts.
That's what I meant, that prior quarter thing. Okay.
Right.
All right. And then the follow-up to that was, if some employees left the company in Q4, does that impact us claiming their wages for the employee retention credit? In other words, they're not sure I understand that. If they left, they can still claim it, even though because they're qualified for the previous.
So if they were active employees during Q4 and left sometime in Q4, they would be qualified wages there. There is a provision in there about payments to individuals that are no longer employees, and those wouldn't qualify. But as long as they're an active employee during that quarter, that would be qualified wages.
Yeah, he actually clarified. He was asking where they left in Q4, but their Q3 wages for those employees would still qualify.
Yes.
Yeah. Okay. All right. I'm gonna wait a minute here to see. That's the end of the questions that we have right now, and we don't need to stay on just to stay on, but let's give people a minute just in case they think of something else. I'm trying to go through my mind and think of all the scenarios and the questions I've had asked.
Yeah, one thing to kind of reiterate there is we're seeing a lot of clients, especially now that we're going into year-end tax planning, and there's been a lot of surprises of us from clients about having to factor in that 2021 credit that they still have not received yet, or even a 2020 credit they haven't received. So just keep in mind that even for cash basis taxpayers, the credit needs to reduce the salary expense in the year those salaries were incurred that generated the credit. So even if they haven't received that 2021 credit payment yet, it still needs to reduce their salary expenses for 2021, and could obviously significantly impact year-end planning and what's going to be due in April.
Well, there's definitely going to be some math involved in having a good advisor to help you make sure that you maximize what you can do. I think is going to be really important. John, I'm just thank you so much for being with us and helping us with this webinar, and thanks to the North Carolina NCA, North Carolina Association of Certified Public Accountants, who put us in touch with you. It's just been a great presentation, and I'm sure that we'll get lots of follow-up questions to that too. So I'd like to also thank all of you who have attended today. And this series, we want to help thank our resource partners, the North Carolina U.S. Small Business Administration District Office, Mike Ariola and his staff, all of the SBA supported business service providers, including the 5 women's business centers, SCORE, the Veterans Business Opportunity Center, and there's 58 North Carolina Community College small business centers that are out there. They are not SBA funded, but they provide a lot of support for businesses, and we collaborate with them quite a bit. Just to remind you, our next webinar won't be till next year. We don't plan on doing another one between now and the end of the year. But this webinar and the previous webinars in this series have been recorded, and the slides will be available online at www.sbtdc.org/coronavirus/webinars.html. The easy way is just go to www.sbtdc.org, click on the banner that says Navigate Your Business Through COVID-19 at the top of the page, and then down near the bottom you'll see webinars. Click on that and you can get the whole list of webinars to view at your convenience. And if you have a request, you want to request an appointment with one of our business resiliency counselors or another counselor at the SBTDC about the employee retention credit or any other business issues that you're facing or opportunities, you can go to www.sbtdc.org/ERFC. And we thank you so much and look forward to having a great new year. Thank you, John.
Sure, thank you, Bob.